Good afternoon. George Cavaligos for HFT Bonds Notes. Well, if you didn't trade them last night, there wasn't a whole lot to do today. I think the range in the 10-year from the pit open until, well, now 320 was 25.5 to 31. Not much there on the bull. And I guess the first trade came in, got short a little bit, covered against 25.5 because that was a 50% retracement of the recent rally. Didn't cover everything. Ended up getting stopped out of the balance. Ended up basically scratching that trade. And then really never got much going here. Never got back up to some levels that I thought would have been decent enough to short. So now we're looking a little bit more downside maybe. I keep watching these Fibonacci retracements. The second wave took 2 full days at least of this recent rally. I'm looking at a very short-term chart. Now we're in what I think is the 4th wave, and so far it's taken 3 days and some change. So I'm thinking late tonight, early tomorrow morning, looking for buy signals. I'd love to see the markets touch that 61% retracement level. That's at 132.21 in the 10-year, 21.22, and 147.05 in the bonds. I think those would be decent spots with good risk reward to get long the market. Stocks could continue this rally a little bit further. If you remember in the treasuries, we've been doing a lot of 61% fib retracements. Well, I'm kind of watching the equities markets, and they've been doing a lot of 79% fib retracements. I'm looking at 1581.5 on the S&P as a 79% retracement of that whole sell-off from 1593 down to 1538. Could be something to watch. And obviously what I'll do is, if it trades up around that level, what I'm going to do is look for reversal behaviors. As you know, on the bonds and notes, I'm going to try and buy new lows here. Maybe we don't get all the way down to 21.22 or back down to 47.05. I think you can see that in the bonds. That's actually the 147.05 is a 50% retracement in bonds. They're holding up better than the 10-years are, and that's kind of bullish. Remember, curve flattening where the bonds are rallying more than the notes is typically bullish. And if you think about it, right, the 10-years come back. We met our 50% retracement already at 25 plus of the recent rally. The bonds haven't yet. 147.05 is 50% retracement. If we're going to do a full-blown, 618 retracement on the bonds, that's all the way down to 146.26. Could see it. 61% retracements have been magic lately, but I'm leaning no, not going to happen. I think there's still this undercurrent of anxiety in the markets after the massive moves we've seen in the gold and silver and the big swings in equities. I think people are just kind of saying enough. It's too much volatility for me. I'm going to get out of that risky stuff and put my money in bonds and notes and take my 1.7% return. I don't know. I'd almost rather put it in the mattress and not get a return, but at least have it on hand. So we're not there yet. Keep an eye on these guys. Did you guys see that Congress actually passed a resolution, and President Obama signed it, that did away with their insider trading ban that they just put up like a year ago after all the dirty business they were doing? That's a great job. What a bunch of crooks. Keep doing stuff like that, guys. Keep doing stuff like that. I'm surprised it's not getting more press. No, I'm not surprised. You guys got the media in your pocket. They're not going to say anything bad about the parties, the political parties. No, enough of my rant. Sorry. Okay. Look for some kind of bottoming signal. Love to buy the notes down around 21.22. Bonds down around 147.05. I think you can work fairly tight stops there, and then we'll see what happens. If we do a full-blown corrective pattern, we could go all the way back down to 132.10 plus and 145.20 something or other. I don't think we're going to see that. I think this is going to be a pretty shallow corrective pattern. Even though the bonds, by making the slightly higher high, turned what I think was a B wave rally into an irregular B wave rally, not confirmed by the 10 years. And typically irregular B waves go lower than normal. They don't do flat corrective patterns where they would stop at that old 146.25 area. Sorry, 145.25. Is that right? Yeah. Wow. 145.25 area. They go even lower than that. I don't think we're going to see it though. But it's just, FYI. Irregular B waves where the market actually makes a slightly higher high and then comes back into the range, or as the Wyckoff analysts call it, an upthrust, is typically pretty negative. We're not seeing that type of activity here though. Not yet. Maybe we will, but that's what stops are for. My analysis says we should try to buy this dip late tonight, early tomorrow morning. The hedge funds are still kind of long. Maybe we squeeze them out of some longs in London. Typically the London hours are when the hedge funds play. So maybe they get hit a little bit. That's when we get my 21s, 22s, and we, say thank you. Okay, got a game plan. Let's see if it works. Have a great night, guys.